I'm Charlotte McLeod with the Investing News Network, and here today with me is Gerardo Del Real, co-owner of Digest Publishing and Resource Stock Digest. Thank you so much for joining me online today. Great to see you once again.
Charlotte, always a pleasure. Congratulations. I know you had some big personal news that we talked about off air. I won't put that here, but congrats. And it's great to see you again. Thank you.
Thank you so much. Always great to have you here. And we have so much to talk about because I think that the last time we spoke was all the way back toward the end of 2021. I remember that one of the topics we went over was people were feeling frustrated about the gold price. And I think if you were feeling frustrated at the end of last year about gold, right now you must be feeling even more frustrated. But when we were speaking, you reminded us that the macro setup was still looking good. So I want to check in with you on that and talk about that macro setup. Does it still look positive for gold?
You know, I think whether we talk gold or lithium or uranium or juniors or producers or mid-tiers, whatever sector you want to pick on to discuss right now, being able to define a timeline on expectation and the kind of return that you're looking for from either the stock or the underlying commodity is so critical right now. And so if you bought gold a year ago because it made perfect sense that we obviously live in interesting times and you thought that volatility would continue and you thought that gold would provide a great hedge in times of volatility, well, you've been mostly correct, but also you've been a little bit wrong if you're US or Canadian based, right? If you look at gold in other currencies, if you look at gold in euros, for example, if you look at gold in some of the other currencies around the world, gold has actually behaved beautifully as a currency hedge for most of the other currencies. And I think in past discussions, I've mentioned how although one day the dollar will go by the wayside, the way all currencies eventually do, it is the cleanest dirty shirt in the laundry basket is the analogy that I like to use. And if you're in a hurry and you have to get somewhere and you need a shirt, you're going to pick the cleanest dirty shirt that you can find and get out of there. And right now the dollar is the cleanest dirty shirt in the laundry basket. And so, I think that if you are US based, you're absolutely frustrated that gold hasn't ran to all-time highs yet. I still see that in the cards. I think we're very close to that with the Fed being as aggressive as it's being with inflation and rate hikes. Inflation, by the way, that didn't exist and then was transitory. This is now the same group that's supposed to take care of it all. I should mention that. And I bring that up to say that, look, I think we're about a quarter or two away from the Fed not being able to be as aggressive as it's being with the rate hikes right now. And I think that the data will provide some cover. Here in the US, we have midterm elections coming up here soon. And I think we'll see a pause in that aggressive hawkish stance. And then we get the pivot that I think the market will front run. And I think that's when gold is going to break out. So yes, if you've owned gold in US dollars, you're probably upset you didn't own more US dollars. If you own gold as a wealth preserver and it's something that is in your portfolio, in your safe, in storage somewhere as a long-term hedge, I think you're going to be pleasantly surprised by year end or early 2023.
Okay, I think that was a great explanation of some of the things that are going on right now. And I'm going to pick up on a couple of them as we go forward. I think the first one to cover is the US dollar. You mentioned it as the cleanest dirty shirt in the laundry, but it is, it's the cleanest dirty shirt. So where is that strength in the dollar coming from? Can you talk a little bit about that?
I think just like I mentioned that we tend to look at gold in US dollars, right? Because gold is the benchmark. I think we tend to look at currency sometimes in a very kind of tunnel visioned way. And, when you take into account the volatility that's going on around the world, we have entire countries that are literally politically and economically collapsing right before our eyes. We have what looks like is going to be a multi-year invasion of the Ukraine and a war with Russia that, China on one side and us and allies on the other are supporting with, hundreds of billions of dollars in aid and weapons. That's not going to go away anytime soon. So when you look at the macro factors that are assisting the US dollar, to me, it's simple. It's capital flight out of Europe, out of other countries that sense that this volatility is going to continue, and also sense that they're no longer going to be able to get the type of returns they were accustomed to when the Fed was buying everything from stocks to mortgage-backed securities. That'll pivot and that'll change. But in the meantime, I think there's another quarter or two of very, very positive dollar strength. And then, as I mentioned, I do think that, it'll pivot. But I mean, we're seeing parity with the dollar and the euro. We haven't seen this in, decades. We're seeing some things that we've never seen. We have an inverted yield curve here in the US. It's, up is down and down is up, and we live in interesting times. And so I think for the next quarter or two, that dollar strength will continue. And then I think we're going to have one of the most interesting 2023s that I've seen in this space for quite some time.
Definitely, we do live in interesting times right now. I think that's something that I'm hearing more and more. And you've talked a little bit about interest rates and what's going on there. We had just recently the Bank of Canada raise rates by a full percentage point, and now upcoming next week, we have the US Federal Reserve with its next meeting. And I know that some people are starting to say we might see the same thing there. What is your sense on what we might see from next week's meeting?
My sense is that central bankers around the world spiked the punch, have drank half of the spiked punch, and are now running around telling everybody that the punch is not good for you and you should stay away from the punch. That's my sense, right? And so I see it as a way to try to save face for central bankers that for decades now have facilitated one of the largest wealth transfers in the history of the world, taking from the majority and really putting it in the hands of those that have leverage and access to financial assets. There are so many traders, whether it's Wall Street or anywhere around the world, that have never traded a bear market. They've traded for 5 years, they've traded for 10 years, and everything has just gone in one direction, right? And now with earnings not being what they were, with comparisons not adding up the way they used to, with multiples being blown out of proportion, and the Fed easing back and central bankers around the world doing the same, it's now having to be a really good asset class picker. If you're going to make money, and be absolutely clear, sure, there are still ways to make money. There are some sectors out there that have such bullish fundamentals that I could care less what happens in the next quarter or two. It makes my contrarian heart smile. The only part that really is, unfortunate is the very human toll that these central bank policies have had on the majority of people around the world. So I say all that to say, I do believe the Fed will hike another 75 basis points, maybe 100, because I do realize, I think the Fed does realize that it has maybe another quarter or so before it has to get out of the way of the midterm elections that we have here in the US. I don't believe we're going to get a Fed that is very hawkish around the midterm elections in the US. And so I kind of see it as a very coordinated way by central bankers to try to save a little face before eventually, tick, 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 eventually it's all going to blow up and we're going to need a monetary reset. I don't know when that happens. I'm not smart enough to call that, but I can add a little bit. I can divide a little bit. I can subtract a little bit. And when I punch numbers into the calculator, I know debt levels aren't sustainable. And I know they're really not sustainable at 3, 4, or 5% for most countries around the world.
Right. So I wondered if we could tie this all together for, let's say, gold investors who are looking at the market. They can see what's coming and anticipate that things will improve. What should you be doing right now? How are you dealing with your portfolio at the moment? Could you expand on that?
I would make sure, as I mentioned when we first started our conversation, that you know the timeline. If you're going to allocate any capital, and by the way, it's a phenomenal time to allocate capital in a lot of these juniors. There are bargains everywhere. But I would caution, you should allocate capital that you don't expect a return on for the next 6 to 12 months, because it's going to be volatile. That would be the first thing. Define your timeline. The second thing that I would absolutely caution is I would be very careful with producers. And we touched on this last time. You asked me about silver, and I mentioned that, I tend to stay away from the silver producers. One, because it's trading as an industrial metal, and I thought it would continue to do so, and that's proven to be correct. But two, I thought inflationary pressures would put a lot of pressure on the balance sheets of a lot of these silver producers, and inflation going one way and the underlying metal going the other as far as price goes, it makes for an absolute nightmare for a lot of the silver producers. So I would make sure that the capital you allocate, you have a good timeline for. And then look, there's some sectors that, again, I'm incredibly bullish on: the lithium, uranium. You don't have to be the smartest person in the world to make some money, but you do have to have a timeline that does understand that there's going to be volatility, and that you may buy something and find yourself down another 30 to 40% here in the next month or two, because I think tax loss selling season is going to start early this year. I think it's going to be brutal for a lot of companies. And I think that if you do allocate capital in this market, you should do it in tranches. You don't, if you have $10,000 or $1 million, you don't have to establish an entire full position in one purchase. Buy a third now, see if you're right in a month and a half, buy another third. If it went up, you'll be happy. And if it went down, you'll be happy that you have a little more money left, and then save a little bit for tax loss selling season. Because I think there's going to be some spectacular bargains that this time next year we'll look back and we won't be able to believe you were able to purchase stock at the prices that I think are coming. But that would be my advice: timeline, allocation, and buying in tranches.
Okay, let's talk about the other sectors that you mentioned that you are focusing on right now. So we've got uranium and lithium. I think we'll start with uranium. I know that our audience always loves to hear about that one. So this is a market where we seem to just keep getting positive things coming into the market, positive factors that keep driving the story along. So maybe you could talk about some of those recent things that you've been seeing there that you think are good for the market that investors should know about.
I think the last 6 to 9 months in the uranium space have been very healthy. And what I mean by that is the consolidation that we've seen in the space, given the underlying fundamentals that, as you mentioned, are incredibly bullish, and not just for a year or two, mind you. We're talking for 5 to 10 years. I don't think this is a 1 to 2 year cycle. I think it'll be bullish for quite some time. But look, we had companies that went up 5-fold, 6-fold, 7-fold. You name it. There were companies that traded for pennies on the dollar and then traded for $1, right? You can't expect those types of gains contrasted with an overall market that's trending lower, where people see their 401ks and they're losing money, and not expect people to tap some of those gains to offset some of the paper losses that they're seeing elsewhere in the portfolio. And when everything goes bearish, it's normal for people to get a bit nervous and take some money off the table. I think it's been extremely healthy. I think the entry points that you're getting in the better uranium names today are excellent entry points for the next leg up. Would I have loved to have bought UEC at 50 cents? Absolutely. And I was encouraging subscribers to one of my paid services to absolutely do that. It ran to $5.50, I think, here recently, before pulling back to the $3 level, $3.50 level. I think the next leg up sends it to double digits. So the consolidation, I think, is healthy. I think for those that missed that first initial run, I think we have another one coming. I think it's going to be extremely exciting and profitable.
Right. And, as we've been talking about, there are a lot of catalysts in there. What would you say is the most important factor for the market right now, given all of the things that are going on?
I think that the largest end user, the utilities, have been asleep at the wheel, much like central bankers on the monetary policy side. And I think that time is going to start running out for them soon. And what I mean is, I think they're going to have to start committing to some long-term contracts, because there are certain entities that are having contracts that are going to start rolling over here in the next 12 months, and they're going to have to get ahead of it at least a little bit. So catalysts abound everywhere. You have a commodity that has bipartisan support globally, right? And that's rare. We don't have bipartisan support on anything right now, whether it's politics, whether it's monetary policy, who makes the best ice cream. Nobody can agree on anything right now, it seems. Uranium is one of those commodities that has overwhelming bipartisan support. And I think that's going to be a large driver of new capital. It's going to be a large driver of new reactors. I think countries like Germany that have stated that they were not going to go ahead and look at nuclear as a viable option. I just yesterday, I saw a comment that they're going to rethink that strategy. And again, it's not because they're benevolent. It's because they have to rethink that strategy. It's the single best option for having safe baseload energy. And I think if you missed that first leg up in the uranium space, when you could have bought the stocks that nobody wanted, like a lot of the gold names people are frustrated with right now, I think there's a next leg up coming.
Okay, and we talked about producers in the gold space, and we said maybe we stay away from those. Do you feel the same way about uranium, because it's a much smaller sector and there just aren't that many companies to choose from? So what are your thoughts there?
Look, I'm a high risk, high reward person that tends to have a longer timeline as a speculator than most people. So I absolutely don't mind, making leveraged bets on the explorers or the developers that have production profiles that could come online relatively quickly, but that are going to make sure that they wait and get that 70, 80, 90, $100 price before turning the key. So when I look at the UECs of the world, when I see explorers like Sky Harbor Resources, which has done a phenomenal job of vending in some very, very, not just projects, important projects, but important technical partners. Those are companies that I gravitate towards. There's a newer company that, and I'm biased with all these companies. I'm either a shareholder or have been a shareholder or plan on being a shareholder, or I wouldn't be speaking about them. But Labrador Uranium is one I absolutely love right now. It got to nearly $2 here when it came out the gate, and now it's sitting there at 60 cents. It's got an exploration program that it just announced here in the last week or two. And I think the second half of the year is going to be phenomenal for Labrador Uranium. It's a newer company, a bit under the radar for a lot of people. But again, there's ways to make money in this market. Just got to have that timeline defined.
Okay, no, and I appreciate the examples. I think everybody always likes to hear what companies you're looking at. So moving on from uranium, let's look at lithium. I will admit I'm not the biggest expert in lithium, but I do know that prices were going pretty crazy last year and the first half of this year. Then we had the Goldman Sachs report saying the battery metals bull market is over for now. So is this a buying opportunity right now that they've created, in your opinion?
Absolutely, and I get great pleasure from disagreeing with Goldman Sachs. So anytime I see a report like that report, which by the way, if people read the entire report, it also cautioned that even if there was a bit of a retracement, because look, lithium prices are up some 500% in the last 12 to 18 months. Again, that's not sustainable. But even if there is a bit of a retracement, even by their own report, they mentioned that they didn't think that would last more than a year or two. So again, if I have a company like Patriot Battery Metals, which we helped finance at 16 cents, which hit a high of 450 less than a year later, and now is pulled back to the 260, 275 area, with a massive discovery, 50 kilometers of trend, drills turning, fully funded, doesn't have to go to the market for cash. A company like that could be a $10 company in the next 6 to 12 months. So if you miss that run from 16 cents to 450, that this pullback now to 270 is a phenomenal opportunity if you like lithium. I don't worry about a company like Patriot Battery Metals because it's not going to be producing anything anytime soon. It's exploring a district scale, a massive district scale lithium discovery that I think is going to end up being one of the most important lithium discoveries in over a decade. And so I don't think it's a coincidence that the Rio Tintos of the world, that the Chinas of the world are investing billions of dollars and actively seeking projects that have scale. Jurisdictional, due diligence has been done on a lot of these companies that are getting taken out. Argentina has seen billions of dollars in Chinese capital over the last several months. And that's a trend that I believe is going to absolutely continue with countries and companies looking for opportunities in the battery metal space that will include copper, by the way, but opportunities that have the kind of scale for long mine lives and massive exploration upside. Patriot Battery Metals checks all of those boxes for me.
And do you think you could talk about any tips you might have for people looking to evaluate lithium juniors? Because I think there's a high degree of interest in lithium for sure, but there's also, some caution. I think people may find it a little bit confusing. It's different from some of the other commodities. There is sometimes a tech element in there. What advice do you have?
I'll be the first to tell you that, much like you, Charlotte, I'm no lithium expert, right? But you don't have to be to make money in this market. I would say this: there are different types of lithium deposits, and as important as the type of the deposit, to me, it's the jurisdiction, the scale, and the management team, and whether or not that management team has an asset that can be scaled out, that can be attractive to a major. Because at the end of the day, those are the projects that are going to continue to be bought out. It's not the smaller projects that have, the same upfront cost as a bigger project, but with a shorter mine life or with less exploration upside. So I would focus on scale. I would focus on jurisdiction. I would call the company and make the company IR people earn their money. Ask them questions. Go to the website, click on the contact tab, and that's how I met one of my mentors in this space, and was by doing just that once upon a time, some nearly 2 decades ago, right? And so I would encourage everybody to call and ask those questions. What makes your deposit better than the one next door? Why is your deposit different than the one that was just bought out? What's your exit strategy? How are you going to monetize this one day? And that's an important question if you're the kind of speculator that wants to stick around until a project is built. You don't have to do that to make money in this space. But again, just define your approach, define your timeline, ask questions, write in, send me an email. I'll forward it to the company and I can put you in touch. I'm happy to do so, but make them earn their money, make them answer your questions.
Those are great questions, and that's such a good point. Those people are there to help investors. So you should use that source of information if you can. I want to finish up with talking about the juniors in general. We went to PDAC about a month ago now, and our team went down on the floor and we asked a bunch of the companies there what their biggest challenge is right now. And financing was really at the top of the list. So I wanted to take your temperature on challenges in the junior sector and how you see them, I guess, overcoming those challenges, hopefully moving forward.
There's two types of companies right now, and I speak with CEOs every single day. There's the Patriot Battery Metals of the world that are sitting on a robust treasury, have three rigs turning, are onto a massive discovery, and the discovery tells the story. The company doesn't need me, the company doesn't need other people to market it. Bottom line is that discovery speaks for itself. They have value adding catalysts that are happening as we speak, and the re-rating for the value that's being added will be spectacular when the market gets better. There's other companies that are hoping the market gets better sooner rather than later because the treasury is lean. They're going to have to raise money on very dilutive terms, and or they don't have an asset that makes people that write checks want to write a check in hopes that they find something. And for those companies, I think it's going to be a tough second half of the year. When I speak with CEOs, there's a lot of CEOs cutting back, and rightfully so, on marketing budgets, on conference budgets, on drink budgets, on salaries, all of the things that go away during lean times. So I think it's kind of a tale of two junior worlds right now. It's the juniors that are going to continue to add value and get taken out by majors and mid tiers. And there's the other kind of junior that, whether it's in the lithium space, the uranium space, the gold space, or the silver space, just kind of hoping we get a better market where, the rising tide lifts all boats. And that's going to get tougher and tougher to come by here over the next 6 months, I believe.
Okay, well, I know that's kind of a sober note to end on, but I think that's where we can wrap it up. You gave us so much to think about. Thanks for coming on, as always, to talk about what's going on.
No, thank you so much. I appreciate the opportunity. If your audience has any questions, I always encourage people to reach out. Happy to give, my 2 cents, whatever that 2 cents is worth. But thank you again for the opportunity, Charlotte.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Gerardo Del Real.